All right. Welcome back to accounting. We are dealing with chapter 2 today, which is going to be basically diving into accounting. Well, what is accounting? Like, what are the objectives and things that you need to know when it comes to accounting? All right. So here you go. Here's the definition of accounting. It is the process of recording, sorting, analyzing, summarizing data, okay, from all business transactions, okay? So, of course, in this class, right, there's different types of accounting. And in this class, since we're learning the very basics of accounting, we're looking at the 101, we are focusing on financial accounting, okay? We're not dealing with taxes today. Nor are we dealing with managerial or cost accounting or forensics accounting. So again, those are future classes that if you do pursue either an accounting degree or are interested in just learning those extra classes, I do highly recommend you to check it out and see if it's something that you want to do instead of financial accounting, right? We talked about the areas of accounting. There's more than just being a regular financial accounting. There, it goes beyond the limits, okay? In this class, you will learn that accounting is essentially learning a new language, right? In English, we know, like, when we understand to receive in accounting terms, that's a receivable, right? To pay something is an expense or to spend, right? To owe is going to be a payable or a liability. If you own property, that's an asset. And of course, if you have an obligation, it's also a liability, okay? Do not confuse debt as liabilities, okay? Because in English terminology, we understand debt as something that we owe, okay? In accounting, it does go that way too, but we understand liabilities as something that we are they're obligations that we must make a payment to, because we owe it, but that doesn't mean we can just write it off whenever we want. It's an obligation that we have to pay. So in this case, you will learn things like on an account. What does that mean? It means that you didn't pay for it or you placed it on an account, and et cetera, et cetera. So again, when we look at the different terminologies between English and understanding it in the accounting language, all right, we are looking at accounting as another form of language, okay? And then we are going to talk about accounts. Now, what are an accounts? Well, accounts are some kind of systematic way to keep records organized by sorting the data within these specific categories, or in this case, specific accounts, right? We have assets, liabilities, equity, revenues, also known as income, and expenses, okay? And these 5 accounts must balance at the end of a given time period. So in this case, like when we talk about accounting periods, which we'll talk about in chapter 4, will give us basically a time frame of when and where to measure either profitability or to measure the value of the company, right? So with that being said, it is very important how we understand accounts and how do we know how to categorize it, okay? So we're going to break it down to you and I'm going to talk about each and every single account, what it is, and how do you categorize it under each type of account. But I do want you to know that the reason that we have these, we use these information to balance at the end of the given accounting period is that because they do hold some kind of value in regards to information about what the company is doing in regards to either profitability, net worth, or just balancing the accounting equation, right? So in this case, I do need you to know that your assets, your liabilities, and your equity are going to be your permanent accounts. Permanent meaning they will never close at the end of a given period, while your revenues, also known as your income, and your expenses close out at the end of a given period. Now, let's give this for an example, okay? An asset, okay? Your checking or bank account is considered an asset. Now, if you close your bank account, right, at the end of a given accounting period, what does that tell the world if you close your bank account at any given time and period?
You don't have any money.
You don't have any money, but what about your business? Why is it important? What's so significant if you close out your bank account?
Does that mean like when you're liquidating your assets, like you're done?
You're
Finished?
correct. You're done. You're finished. You don't have a business anymore. All right. Same thing goes with liability, right? If you close your liabilities at the end of a given accounting period, the shark loans are still going to come after you, no, regardless. All right, because you owe them money, they're still going to go after you by liquidating your assets, right? Or they're going to come after you to find any means to come after you for their money. Whereas revenues and expenses, right? These typically close out at a given period because if we understand revenues, right? We may have a reoccurring customer that comes into the store and buys the same thing over and over again, right? But can we really predict that that customer, what if that customer one day comes into the store and buys something completely different, right? So in this kind of case, right, my revenues will always fluctuate at a given accounting period, right? This month you might have a promotional sale. Next month you might have, promotional sale, or maybe you have a slow month where you don't have that many customers, right? So that's the idea here, where your revenues or your income will fluctuate at a given time period. Same thing with your expenses. Yes, you can have fixed expenses like rent that stays consistent throughout every single month. But hear this, right? If it's the month of July, you have special holidays that you might have to spend a little more to promote yourself, to get yourself marketed out there for more customers to come in. So in this case, right, your revenues and your expenses typically fluctuate at a given time period. So it is the safest way that we can close out the end of a given accounting period to measure profitability. Okay? So that is why it's very important. And again, it's a perfect measure because if I start from zero every single month, right, I'll be able to measure, okay, maybe this month I created a lot more, I generated more revenue this month, and then, or the next month, I incurred too many expenses that month. Okay, so that is a perfect exact example of why my revenues and my expenses are considered temporary accounts, because they temporarily stay open. They close out at a given period to have a goal to measure profitability. Okay, where your permanent accounts, they can never close out because given the circumstances, right? I just gave you an example. You can't close out your bank account. You can't close out any debt that you owe or any liabilities that you owe because they're still going to come after you. Okay? And in this case, there's no determining factors of what it can measure except for the net worth of your company. Okay? All right, so let's go actually talk about what specific accounts do and how we organize it. Okay, so we organize it based on three criteria, right? A main account, sub account, and a contra account. Now, understand the main account, sub account, and contra accounts just like you open up a textbook or open up a book, right? You usually have a table of contents, right? The main account is going to be the chapter, right? And the sub account is going to be similar to the topics that are going to be, discussed within that chapter, right? So it's the same thing here, right? Where the main account, right, is a generalized account, and the sub account gives the main account more detail. All right, and typically they flow in the same direction. Okay, now in this case, what does that even mean? All right, we'll talk about that when we dive right into the accounting model, but just understand this, right? If the main account goes one way, right, then the sub account's going to go in the same direction. Okay, now when we talk about a contra account, right, contra meaning opposite, it goes in the opposite direction, right? A contradiction, right? The opposite of the exact word, contra. So that in this case, it does give the account, the main or sub account more detail. However, it flows in the opposite direction. So again, if my main account goes left, then my sub account is going to go left. My contra account is going to go right. Okay. Now, again, in context, right, a main account, a great example is going to be inventory, right? Inventory is such a broad account because in business terminology, right, you have inventory. Okay, what does your inventory consist of? And that's where your sub account is going to come into play, because you can break down the main account into further detail, which saying, well, in my inventory, I have coffee mugs. I sell coffee tumblers. I sell water bottles. I sell etc., etc. Okay? And again, a contra account, which flows in the opposite direction. So it could give either the main or sub account more detail. So for example, we have an accounts receivable, right? Accounts receivable is the main account, right? And that is basically tells us that customers can owe us money, right? They're not obligated to pay right then and there. What an allowance for doubtful accounts is it is an account that you would use in case a customer decides to fault on their payments. Okay, and that would reduce the main account. That would reduce the amount that the customer owes, because you're placing it in an account that represents potential debt. Okay, so that's actually how we understand how our accounts are normally organized, or how we further separate our each and every single account. Okay, so any questions here?
No.
Okay.
No.
Okay. So, of course, the very obvious thing about accounting is learning the debit and credit system, okay? When we refer to debits and credits, we refer to debits as left and credits as right, okay? In English concepts, right, we understand that debits and credits either increase or decrease, okay? No, that is not true. Do not put this in your head that debits mean to increase and credit means to decrease. Because in this class, right, we're going to learn that debits can either increase or decrease depending on which specific account type you're looking at. So a great example, right, we'll talk about that when we hit the accounting model, but do not refer to debit as increase and credit as decrease, because it depends on what account you're looking at, okay? Just if you are trying to refer what they are, refer to them as left or right, okay? Now, in this case, when we take a look at our general journal, okay, we'll look at that in chapter 3, you'll understand why it's called left and right, because the way that the columns are created, debits are going to be on the left side of the column, credits are going to be on the right side of the column. That's pretty straightforward, okay? How we use the debits and credit system, which we will talk about in the accounting model, whether we use a debit to increase the account or use a credit to increase account is going to determine basically how we understand how a transaction works. So in this case, when we're taking a look at understanding debits and credits, just know that debit means left, credit means right. Okay? We're also going to be taking a look at the fundamental accounting equation. This must hold true at the end of any given accounting period or just accounting in general, right? Your assets will always equal liabilities plus equity, okay? Now, yes, there's different ways that you can see this as well. You can, I know that in the accounting book, it tells you that this is the formula here, but you can also look in aspects of your equity will always equal your assets minus your liabilities. Okay, that is also true as well. Okay, equity can equal your assets minus your liabilities, but in this case, right, this is in regards to your balance sheet, because your balance sheet separates your assets and it separates your liabilities plus your equity. So again, this is based off of the balance sheet is based off the accounting equation, which is your assets must equal everything that you owe plus your net worth. Okay, so again, this equation must hold true wherever you are in any given standpoint in accounting. All right, and we will test this equation at all times. All right, but where we see this more predominantly is going to be testing this either during the class project where we actually complete the balance sheet, but I will also test you on simple math as well. If I give you scenarios saying your assets are this and your liabilities are that, what is your total equity, okay? So understand that this is a your assets equals your liabilities plus equity. Okay, that is the accounting equation. Okay. So let's go ahead and dive right into our permanent accounts, which is your assets, liabilities, and equity, and break it down by one at a time. Okay, starting off with assets first. Okay, assets. Okay, what does it mean? Assets is in terms means it's going to be everything that you own. So O-W-N. Okay, you own it. You have ownership over it. You have property over it, right? So in this case, right, a great example would be cash, a checking account, inventory, right? You own inventory before you sell it. Anything that is furniture, right? You own furniture, you own the equipment, and anything that's intangible is going to be such as patents and copyrights, right? Those are everything that you own in a company. Now, how do we categorize it? So the categories of assets, right? Normally, when we list out our total assets, we also have another kind of subsection that we organize our assets even further, right? It's not like you can just list all your assets and call it a day. In this case, we have to further organize it into categories, which in assets, there are a total of 3 categories, okay? You have current assets, fixed assets, and other assets, okay? Now, how do we determine what current assets and fixed assets and other assets, right? We determine it based on liquidity, okay? Meaning how readily available is it in the simplest form, which is cash, okay? That's how we understand how we further categorize our assets is based on how readily available or how easily can it be converted into cash, okay? So current assets, right? You would typically normally have it based on how quickly you have it in cash, which is going to be anything that you can liquidate or basically spend within a year. So cash is already in its instant form, right? Accounts receivable is when your customers owe you money. You're able to convert that into cash by going to your customers, harassing them until they give you your money, okay? And then, of course, you have inventory, right? You can choose, well, I want to make money today. I can choose to sell my product right today, right then and there. Okay? Those are going to be considered your current assets. Okay? Then we're going to talk about fixed assets. Fixed assets, okay? I'll give you this way to also be able to memorize it either as well, is that it's also known as PP&E, okay? PP&E stands for property, plant, or equipment, right? PP&E. That's the best way to be able to determine fixed assets, right? Property is going to be anything that you own, whether it's the land, the street, the sidewalks, okay? The plant is going to be everything that's inside a building, right? So that's what plant is, right? It's the building. So anything inside a building, right? Furniture, desks, lamps, whatever, right? Tables, chairs, okay? And of course, equipment is going to be any type of machinery that either helps operate the business, okay? All right, so let's take a look at that. Now, in this case, right, because we're determining based on liquidity, right? Now, how quickly can you sell, let's say, a piece of land?
More than 2 months.
It could be definitely more than 2 months because you have to go through escrow, you have to go through, you have to go through a realtor. They have to appraise the land. They have to go through all these different paperwork, court papers, and they also have to go through putting it on the market. And if no one wants to buy it, then it's going to stand in the market for even longer. But if there's a potential buyer, then they have to go through escrow, run their credit score. It will take anywhere from more than 2 months. So think about it, right? If I have inventory that I can turn around and convert it into cash almost instantly, this is exactly why your fixed asset would be determined as a fixed asset, because it takes longer to get money out of it, right? It takes longer to sell your land. It takes longer to sell a building. It even takes longer to sell furniture, right? You have to put it on either Facebook Marketplace or Craigslist. That person has to come and see it, and then they have to kind of look at it and agree. Do they want to take it? They might even ask you, well, think about it, and then you have to keep calling them until they said, okay, let's buy it. It takes a long time to convert these types of fixed assets into cash, okay? So property, plant, and equipment is going to be your fixed assets. So again, property meaning anything that you own in regards to land, right? Plant is anything that you own inside the building, and equipment is going to be anything that you use to operate your business, okay? So those is going to be something that it will take you longer than a year, okay, or a couple months to convert into cash. And one also quick notion here is that typically fixed assets have lifespans, okay? And we'll talk more about that in chapter 11 when we dive into depreciation, because again, when you acquire a fixed asset, right, it has a lifespan of its own. And how we determine that and how we use it through our business is going to be determining how much we need to depreciate it, okay? Instead of appreciate, we're going to depreciate, right? Make it lose its value, okay? All right, and then last but not least is going to be other assets. Now, in this case, a unique way to understand other assets is they're typically going to be intangible, okay? Have some kind of life, right? They do have a life, but the only real factor about it is that that you can't touch it, okay? It's intangible, okay? So if you think about it, a copyright a license, a patent. Can you actually touch those?
No.
No, right? A patent is an idea, right? A copyright is some kind of legal, invisible force field over an idea, right? Same thing with a license. A license is a license to give you permission to do something, right? Can you touch a permission slip? In real life, yes, you can. And that's exactly what it is. So when we take a look at intangible assets, it literally is just a piece of paper. Okay. Yes, you could touch the piece of paper, but can you actually touch what it physically does? Right? Can you touch a patent? No, it's just a protective force field, right? You can't actually touch it. So that's one thing that you are able to understand here, is that it's usually intangible, but we're talking about in terms of organizing it based on liquidity. Now, I'll give you another example, okay? What if I have prepaid rent? I paid somebody in advance to give me rent. Now, of course, I can't touch rent, but do you think it's easy to get that rent money back? Okay, so most cases, right, a lot of landlords, depending on the landlords, they will fight you to the end, and you'll never get your money back. Okay, that's just most landlords, because it's like you have a contractual agreement, you sign the papers, you cannot. It's legally binding. You cannot go out of the contract. So you sign the paper, you wrote me the check. You're not going to get your money back. Okay? And sometimes if it's that bad, that's where you have to go into legal courts. And of course, like I've mentioned before, it's almost near to impossible to get your money back. Okay? Same thing with the patent and copyright, right? You won't be able to necessarily get your money back unless you either extend it or you go sell it to somebody else. But in this case, right, the patents, licenses, and copyrights, right, especially licenses, it's a contractual agreement that you are agreeing to continue on another business. You can't really get out of that contract. Okay? You can't sell your license to somebody else. No. All right? You would have to go through legal terms to get yourself out of the contract. Okay? So in this case, these will even take even more long time and forever to get your money back. So is it easily converted into cash? Absolutely not. So that's exactly how we organize our assets even further based on categories. Okay. Any questions here?
No.
No.
Okay. Next one is going to be talking about liabilities. Okay. Now in this case, right, liabilities are anything that you owe to either other people, the bank, government, whoever, right? Owe with OWE, okay? Meaning you created some kind of debt to other people, okay? You owe them money, okay? Now again, like I mentioned this before, liabilities are not debt, right? In English terms, we understand them as obligations. Why? Because we are obligated to have to make payments back. It's not debt that you could say, oh, I owe this person so much money, I don't need to pay them back. No, that's what debt means, right? That you owe somebody money and you're either choosing to pay them or not to pay them. Okay, where in this business terms, right, we understand that our debt or our liabilities are something that we have to make obligations to pay, okay? Especially when we talk about accounts payable, right, where a vendor can give us 30 days to make a payment. Now, so yes, you owe $30 to a person and they give you 30 days to pay it back. That means you are obligated to have to pay, or else after those 30 days, they're going to come after you. They're going to charge you up. They're going to charge you for late fees. They're going to charge you interest, okay? They're going to charge you a lot of other things. And you don't want to do that. You don't want to create more debt on top of another debt, because in this case, it is an obligation that you have to pay them within 30 days, okay? Now, how do we, in this case, right, we also have categories to determine or to organize our liabilities even further as well, right? We have current liabilities and long-term liabilities, okay? Do not ever refer current as short-term liabilities, okay? They are not short-term liabilities, even though the definition kind of says it's a short-term liability, but in this case, we never refer our current liabilities as short-term liabilities, okay? It's current and long-term. Okay? Our current liabilities, right? The way that we organize our liabilities is going to be based on how long you owe a specific person, okay? So again, current liabilities are going to be obligations that you have to pay either within a year or so on and so forth. So again, accounts payable, right? Any vendor, like a credit card company, that gives you 30 days to pay back, right? If that's the case, they only give you 30 days. Now, most cases, right, they give you 30 days, 60 days, 90 days, whatever the amount is, right? It's going to be whatever you agreed upon. But that's going to be less than a year, right? 30 days is only 1 month. So in this case, right, that's going to be considered a current liabilities because you're owing somebody money for less than a year, okay? So great examples would be accounts payable, sales tax, right? You have sales tax, the maximum you can go for paying the government their sales tax money is 1 year. They're not going to let you keep it over than a year. In fact, some of them, depending on what kind of business you are, they might expect you to make payments to them either monthly or quarterly. Okay? Other things in that too could be interest payable, right? Obviously, anything that you owe, whether it's a credit card company, they're going to charge you interest every single month. So in this kind of case, you have to pay that interest almost instantly, okay? And then long-term liabilities are typically going to be anything that you owe for more than a year. So a perfect example is going to be typically loans, okay? Loans, right? If you have a short-term loan, it will actually say short-term loan. If you borrowed it for only 6 months, then it will be clear that that's a current asset. But anything more than a year, because typically loans could be 3, 5, 10, 15, it could even be 36 years, right? Home loans or residential loans usually are, anywhere from 36 to 40 years loans, okay? Again, a business loan, depending on what it is, right? Usually it's typically 3 to 5. Same thing with any truck loans, or if you borrowed money to buy a vehicle. Typically, those are also spread across either 3 or 5 years. So definitely more than a year, you're going to categorize them as long-term liabilities, okay? Any questions here?
No.
Okay. And then now we're going to talk about equity, okay? Now, there's a few things that you need to know about equity, right? Depending on what kind of business you are, right? And in this case, we're learning just sole proprietor. So our equity is going to be owner's equity, okay? But if you do look at other equity, such as either corporations, partnerships, or something like that, you're going to learn that their formula is kind of actually different to determine what equity is. Now, in this case, right, we need to know that equity actually means that it is basically your net worth of the company, right? What is the value of your company? What is its standing point right now, okay? Now, here's a few things that you also need to know. Equity do not have categories, okay? They do not have any categories, okay? They just simply have just regular main accounts in under equity, okay? Except for, of course, things like if you do a corporations type of equity, right? Stockholders equity, they do have categories. They have retained earnings, and then they have capital stock, and then they have those are the two categories under stockholders equity. But in sole proprietors, when you only have an owner's equity, right? There's no categories, okay? So I will test you on this. Do equity have categories? And you must say no, okay? It's going to be, I'm going to test you on it on both quiz, exam, even and the exercises, so you make sure you don't answer this incorrectly, okay? Equity do not have categories, especially owner's equity, okay? Because we will never talk about retained earnings in this class, okay? So what is going to be equity, right? Typically, it's going to be any of your capital contributions or your net income, okay? And then it's going to also subtract any owner's draw or any net loss, okay? So usually these are going to be your determining factors of how equity is going to be again, how you figure out equity, right? Besides looking at the other equation where your assets minus your liabilities will determine to you what equity is, okay? And in this case, right, these are contributing factors that could increase your equity or decrease your equity. So again, capital contributions are going to be if you invest your own money into equity, of course that's going to increase the value of your company. If you have a net income and you reinvest into your company, that will definitely increase your equity, okay? Other contributing factors that decrease your equity is going to be if you take money away from your company. And of course, if you have a net loss, okay? All right. So again, well, net loss and net income, right? How do we figure that number out? It comes in from knowing income, okay? So in this case, right, understanding that revenues minus expenses will either give you a net income or a net loss, okay? So in this case, right, this is where we learn about our temporary accounts and how we further categorize our temporary accounts. So in this case, right, when we learn about revenues or income itself, doesn't matter, right? They're both interchangeable. Revenue, income, however you learn it, they're the same. It's a means of generating income for the company, okay? What is your primary way that you're generating revenues, okay? So that's where you have operating revenues. Now in this case, because we're looking at merchandising inventory, our main core of generating income is going to be through sales, right? We are going to be selling a product, okay? We're going to be selling service, okay? So there you go, okay? And then, of course, other income, or you also have non-operating income, are going to be things that you earn money that's separate from your main core of operation. So if you have stock in another company, right, and you use it towards this, right, because you guys are considered partnerships, right? Maybe you're bouncing money off of each other, right? You're using it to support, or when you merge two companies together, right, what happens, right? They become one, and you're basically bouncing revenues off of each other. But that's separate from your main core of business, right? You're not in the business of earning money through stock. You're in the business of selling a product or service. Okay, so that's how we understand what other income or non-operating income comes into play. Okay. And of course, we talked about expenses. Expenses are going to be anything that you either spend, use, or get rid of for the business, okay? Especially when we talk about cost of goods sold. Cost of goods sold is one of the categories that you're going to be looking at under expenses. Cost of goods sold is going to be directly correlated to inventory, okay? Now, how do we understand what it means to expense it? Expense it in terms of cost of goods sold is, did you get rid of your inventory? Okay? Did you use your inventory? Okay? And of course, then we have our second category, which is going to be operating expenses, which is going to be, what did you spend for the business? So I spent money on rent. I spent money on advertising. I spent money to purchase inventory. Okay? Okay, so that's how we understand what expenses are, is basically any means where we either use, spend, or get rid of items with that in order to operate our business. Okay? And of course, last but not least, the last category that you would see, but we'll see, will be non-operating expenses. Again, in this class, we do actually not get to see examples of non-operating expenses, just because we're looking at a merchandising inventory in a smaller grand scale. But when you do move up forward, if you do plan on going into accounting degree or something like that, you will go through cost accounting, managerial accounting, taxation, all those different ones. And that's where you'll understand where non-operating expenses come into play. Okay, so non-operating expenses could be labor expense, right? It could also be considered, if you have inventory, right? Inventory is part of your operations because your main goal is to sell it, right? But if I have a facility somewhere on the land to hold my inventory, okay, is that the main core of my operations? Is my job to safeguard my inventory? No, it's to sell your inventory. So in this case, right, any costs it takes that you have to rent the warehouse. Maybe you need to have temperature control. You need to hire security to keep your assets safe. Okay, that's going to be considered non-operating expenses, because this isn't directly correlated with your main core of operations, right? Your job isn't to protect your inventory. Your job is to sell the inventory, okay? All right? So that's how we understand those different types, okay? So that's how we categorize our revenues and categorize our expenses, okay? Any questions here?
No.
Yeah.
Well, okay. So now we are finally here. We can talk about the accounting model, okay? The accounting model is going to be determining which account types and how the flow of transactions work. So this is where we're going to use the debit and credit system, and how it makes it easy to understand how we organize our information, but how they flow in terms of the transactions. So I've mentioned before, right? When we talk about assets, right, if we increase our checking account, right, by physically putting money into the bank account, right, in accounting terminology, we understand that as we're going to debit our assets, okay? So this is where I was talking about earlier when we were talking about main accounts, right, where and also how debits and credits work, is that in this case, right, this is a great example to show you that assets, right, or debits, you can increase an account, but at the same time can decrease another account. So let's take a look at this, right? Assets normally are increased by debits, okay? Where if you use a debit on a liability, it decreases it in value, okay? So in this case, when we understand how a transaction works, we need to know that this is how we must use the accounting model to understand how the flow of transaction actually works. So a good example is, let's say I paid for rent expense. If I paid for rent expense, right? Therefore, I increased my expense with a debit because I spent money in order to get rent. So therefore, I increased my expenses because I spent the money for rent. So I use a debit to increase my account. But I had to spend money. So in this case, I would use a credit because I spent money. I had to use cash in order to pay for my expense. So in this case, I would decrease my asset because, cash is, or your checking account would be considered an asset, and I would decrease the value in my checking account. Okay. Now, when we talk about understanding and how to properly journalize, that's where I'll get into the rules and regulations of what you need to have, because we need to have our debits match our credits at the end of every journal that we do. All right. So again, that's in chapter 3. But in this case, right, this page is going to be page, I believe it's page 2 or page 5 in your chapter 2 lecture notes, right? You have a little graph that has the arrows for each account. I would recommend you to print that out and save it, post it somewhere where you can see it at all times, because that's going to help you determine how the flow of transaction actually works, okay? And again, let's take a look at this. Notice this, right? What does it mean that I have a normal balance? A normal balance basically typically says that whichever side that is positive balance, right, in each specific account. So what does it mean by positive balance? Okay, so let's take a look, right? We understand that debits increase an asset, right? That's a normal balance right there, okay? Because it's going to increase it on the positive side, okay? Where your liabilities, right? Because in this case, when we talk about increase and decrease, we're literally increasing the value or decreasing the value. So in this case, right, when we talk about liabilities, it normally is increased with a credit. It's going to make it positive at the end of the day on the credit side. So that's how we understand what a normal balance does. Okay, so if you take a look at this, right, we have assets are normally increased by a debit, okay, and our expenses are also normally increased by a debit. However, my liabilities, my equity, and my revenues all are increased with a credit. Okay, so if you can understand it that way, and so it could, keep you in check, or to know that if you think of it this way, your assets and your expenses are normally going to be flowing in the same direction, while your revenues, your liabilities, and your equity are going to flow in the opposite direction. Okay? Any questions here?
No.
No.
Okay. So again, we won't actually see this being used until chapter 3, and of course chapter 5 and beyond that, because our main goal is, after you learn chapter 3, from here on out, the goal is that this class is to teach you to be a bookkeeper and the accountant, right? The bookkeeper's primary job is to record. Well, what am I recording? You're going to be recording in the general journal. And this is the most important thing you need to know when it comes to journalizing a transaction, okay? So again, depending on which account type you're in, right, will determine how the flow of transaction actually works. Okay? So let's talk about the bookkeeping system, okay? So when we talk about bookkeeping system, there are two systems that exist in accounting, right? There's a single entry and there's the double entry, okay? Now, under the single entry, right, you only record a transaction in one place. So a great example is your when you write a checkout, right? At the top of your checkbook, you should have like a little ledger account thing that basically helps you record what check you wrote, when did you write it, who did you write it out to, and why, right? It gives you like that little mini ledger, right? And if you just only record it in that one specific place and you call it a day, that is literally only recording the transaction in one account, okay? But if you do a double entry system, okay, is where, okay, so if I have that same exact example, right, I recorded a check that I wrote out, but let's say because I wrote it for to pay for rent, I also say in my books that I paid for rent expense, right? I increased my rent value for the month of May, okay? That is where you are putting more information, recording in two different accounts, right? And this is the rule here. When we are looking in accounting, okay, especially in this type of accounting, bookkeeping, right, we must use the double entry system, okay? All right. However, I'm not going to shy away from the single entry because when we dive into QuickBooks actually uses the single entry method as the user, right? You enter it in one way, in the background, it will do the double entry behind the scenes for you, okay? But in this case, right, we just fill out a sales form, we just say that we received money, and that's it. That's recording it in one account. In this case, right, we are going to be using the double entry method, which allows us to take a look at two or more accounts and say that, well, I spent money for rent. So I am tapping into two or three or more accounts and recording it in a book. All right. And this is where the number one rule is going to come into play, where your debits must match your total credits. Okay. So if I increased rent, right, that's a debit. But in order to increase my rent, I had to spend money. And in order to spend money, I must credit my asset account. Okay. Is this clear?
Yeah.
Yeah. Excuse me. Okay, so for this class, for the accounting class, we will understand that we are going to be using the double entry method. Okay. So course review, once again, we got to take a look at what the normal balance is, what accounting is, okay? What the 5 main account types are: asset, liabilities, equity, revenues, and expenses. We understand the accounting model, right? Assets and expenses are normally increased with a debit, while everything else is increased with a credit. Okay. We understand that debit means left and credit means right. Okay. And then here you go. I have the list of all of the account types with their respective categories. Okay, so that's also what we learned today too, is that each account type is going to be broken further down into categories. Okay, now notice this: equity, I put it in capitals, no categories. Okay, I even separated between your temporary accounts and your permanent accounts. Okay, all right. So let's go ahead and take the next next half hour to go ahead and go over through the exercises, okay? So here we are, chapter 2 exercise, okay? Number 1, what are the 5 types of accounts?
Accounts receivables.
Okay, that's an example of an account.
Oh,
What are the 5 account types?
assets,
Assets,
liabilities, equity, revenues, and expenses.
good. Okay, let me fix this. This spelled liabilities wrong. Liabilities, okay, good. What is a main account?
A account that makes up a list in a certain type of an account.
Perfect. A accounts. Wait, hold on. A main account. What did you say?
Account that makes up a list in a certain type of an account.
Okay, a list of accounts. Good. Okay. What is a contra account? Okay. Wait, hold on. Let me add to this. Typically flows in a certain direction. Okay. What is a contra account?
Account for depreciation of assets.
Okay, so that's an example.
An account used in a general ledger to reduce the value of the related accounts.
Okay, I'll accept that. Okay, so I'm gonna say gives main or sub more detail, right? Which you just said in any specific account. More detail. And you said, what was it? It typically decreases an account or?
Reduces the value of the account.
Okay.
Yeah.
Okay. So, and reduces the value in a specific account. Okay, so, all right. So I'm going to say flows in opposite direction from the main / sub count. Okay. Good, okay. What does left mean?
Debit.
Debit. What does credit mean? I'm sorry, what does right mean?
Credit.
Credit.
Credit, okay. All right, what is the accounting equation?
Assets equals liabilities plus owner's equity.
Good, okay. Liabilities plus equity, okay. All right, what are the 3 categories of assets?
Current assets.
Fixed
What else?
And other assets.
Okay. What are the 2 categories for liabilities?
Current and long term.
Good. Okay. What are the categories of equity?
Capital contribution and revenue.
No,
Is that what you mean?
no. What did I say about this one?
Okay.
There is none.
None. There are no categories, okay? Capital contribution is going to be something that is an account, an example. So if you look in the PowerPoint, right, I gave you an example of what it does, how it increases it. That it's not technically a category, okay? So in this case, there are no categories under equity. Okay? What are the categories of expenses? Categories of expenses.
Cost of goods sold.
Good. I'm going to do COGS for short. Cost of goods sold. Actually, I'll just type it out. Cost of goods sold. Good. What else?
Operating expenses.
And then last but not least, I'm not going to require you to know this, but operating expenses do exist. Okay. Right? What are the 2 categories for revenues?
Operating revenues. And other income,
non-operating.
Good. Okay. What are the 2 accounting systems?
single entry and double entry.
Good. Make sure you have single entry, not just single or double. Okay, it has to be single entry and double entry. Okay. And then last but not least, what is the normal balance?
Positive.
Positive. What? Positive side in a specific account. Okay. So whether it's debit or credit, okay? All right, and then lastly, number 14, okay? Examples of accounts for the following exercises. So this is going to be, I'm going to give you a list of a whole bunch of accounts, right? With their account description, right? What's your job to do here is you're going to tell me what account type does it belong to? What category does it belong to? And what is its normal balance? Magdi, your microphone's on. Okay, so again, this exercise is to determine, so then you are able to understand, right, how you are going to sort out the information, right? Especially understanding what the account type it belongs to, what category it belongs to, and what is its normal balance, whether it's a debit or a credit, okay? or in this case, use your accounting model and tell me what would it normally increase with, okay? So again, you have the little table here that kind of gives you information. So I'm going to use abbreviations as well. So A for assets, L for liabilities, OE for owner's equity, R/I for revenues or income, and EXP for expenses. Excuse me. All right, and then the categories, right? You have C for current, you have F for fixed, you have O for other, you have LT for long term, right? You have OP for operating, OI for other income, and then you have COGS, which is cost of goods sold. All right, so let's go ahead and work on this together. So first one we have here is going to be a checking account, which is going to be money in the bank. What is going to be the account type, category, and normal balance for a checking account? It's money that you have in the bank.
Asset.
It is 100% an asset because you own it, right? You own the money in the bank. Okay, hold on, let me reformat this. Whoa, I don't want everything, I just want. Okay, you own the money in the bank. So in this case, it is 100% an asset. Okay, now what kind of asset would it be? What did you say, Magdi?
Permanent.
What does that mean?
Not close.
Okay, anybody else can want to guess what kind of an account, what kind of asset this would be? What's the categories?
Current.
It would be 100% current because it's money in the bank. It's already in its liquid form, right? It's already available in cash. So good. So it would be a current asset. Now, what would typically increase an asset account, or in this case, increase a checking account? A debit. Good. Correct. Okay. All right. So, okay, that's the first one. Second one is accounts payable. Okay. When money you owe to vendors. Okay. So you owe money to vendors. What is that going to be?
Liability.
100% a liability because you owe money. Now, what kind of category would it belong to?
I want to say no, it's not operating.
No, it's not operating. Okay. What are the categories of liabilities?
Current liability.
Current liabilities, yes, because in this case, you would typically owe your vendors definitely 100% less than a year, right? Unless you're, contracted with them for a year, then yes, that will be that kind of case. But in this case, right, this is vendors that you owe on the daily, right? Whether it's a place that you get your supplies from or something like that, they're typically going to allow you to owe them for either 30, 60, or 90 days. But they are never going to let you owe them for more than that, right? So in this case, it would be a current liability. Now, what would the normal balance be for a current liability? How would you increase it? You would increase it with a credit. Good. Okay, good. Okay. What about a copyright, okay, which is a legal documentation of ownership or rights?
Asset?
It's 100% an asset, okay? Now, what kind of asset would it be?
Other? No.
Nope, you had it right. It is an other
Oh,
asset. Because,
I was.
go ahead.
Oh, I was just about to say other income.
Okay, no, not other income, right? That's gonna
Yeah.
be considered income, right?
Yeah.
So in this case, no, you were right. It was other asset because it's an intangible asset, right? Copyrights, you can't touch them. All right, so what would its normal balance be? How would you increase? You would increase it with a debit. Good.
Because assets.
Because it's an asset. Good. All right. What about supplies? When you need to buy supplies, okay, that are needed to operate the business. So this could be, materials that you need for the store. What would you consider this?
Assets.
It's 100% an asset because in this case, when you buy supplies for the store, you own those supplies. Now, what kind of asset would this be?
Current.
It'd be current because you'll either use the supplies or you can go back and sell those supplies really easily. Okay. And what kind of normal balance would this have?
Debit.
Good. It'd be a debit balance because that you would normally increase an asset with a debit. Okay. What about loans? Okay, owing money to a bank for over a period of time. So in this case, loans typically are more than a year. So how would you categorize or what kind of account would this be?
Liability.
100% a liability because you owe money.
Long term.
100% long term because most typical loans are going to be for more than a year. And what kind of normal balance would this have?
Credit.
Credit, good, right? You would increase liabilities with a credit. Okay. What about accounts receivable, where customers owing the business money? Okay, where you allow your customers to owe you money.
It would be an asset.
It would 100% be an asset, okay? Because you technically own the money that your customer owes. Okay? And what kind of asset would this be?
Current.
It would be 100% current because you can, again, go to the customer and demand the money back that they owe you. Okay? Now, in this case, what kind of normal balance would this have?
Debit.
This is debit.
Yes, right? You always increase assets with a debit. Good. What about an owner's withdrawal? Okay, taking money out from the business.
Owner's equity.
It's going to be an owner's equity account because this is dealing with the money that you put into the business. Now, in this case, I'm taking it out from the business. So, what category would this belong to, and what? So, what's the category for owner's equity?
There is none.
None. Good. And in this case, am I increasing or decreasing my owner's equity?
It would credit.
No. Because if you credit an owner's equity, you're increasing the account, right? In this case, I'm taking money out from the company.
Oh, debit.
Then yes, you would normally debit this account because you're not increasing, you're taking money away from the company. Good. Okay. Next one's going to be advertising expense, okay? Marketing for the business.
Expense.
It would be an expense. Good. What kind of expense?
Operating.
It would be 100% an operating expense, right? Because you're not selling inventory, so it's not directly correlated to it, but you are spending money in order to operate or run your business. Good. Now, what kind of balance would this have? Debit, right? You will always increase expenses with the debit, okay? What about cost of goods sold, okay? The cost of items that you sell.
Expenses.
Expense, good. And it'd be cost of goods sold, right? I heard that. Okay, so again, now how would you normally increase an expense?
Expenses.
Debit, good. Okay. What about inventory, right? Items that you purchase that you plan on selling.
Assets.
It's 100% an asset, good. Right? Because when you purchase these items, right, you have ownership until you sell it. So good, it is an asset. Now, what kind of asset would it be?
Mm,
Other?
Now, in this case, can you physically touch inventory?
Yes.
Can you sell it around within 24 hours?
oh, it's fixed.
Yes.
Okay. Now, in this case, yes, you can touch it. So it's now you're down to either fixed or current, right? In this case, I can convert this into cash almost instantly, right? I just open up my store and say, I want to sell my inventory. And I can get cash for it immediately.
Oh, so it would be current.
It would be current, right? Where a fixed asset, if you have something like furniture, how long is it going to take you to convert that to cash? It will take you some. It will take you. It will take you a couple, at least a few minutes there, okay? Or it will take you at least a couple days. Okay? Now, in this case, right? What kind of normal balance would an inventory asset have?
Debit.
Yes, it would be a debit, right? Because when you increase ownership and you have it, you're going to debit it. But when you sell it, then you would decrease it. Okay? What about land? Land is considered property.
It would be an asset.
Good. Now, what kind of asset?
Fixed.
Fixed, right? Because it falls under the category of PP&E. All right. Now, what kind of normal balance would this have?
A debit.
Yes. Okay. Okay, so a couple more left. Okay. Sales, okay? Earned money from selling a product or service. Okay. What would this typically be?
Asset?
In this case, it would not be an asset because you don't own anything that you are selling. Oh, actually, I just said that wrong. You wouldn't, okay, you wouldn't be earning, or in this case, you wouldn't own the earnings. Okay, never mind. That's even more wrong. In this case, sales. What is the purpose of sales if you're earning money for selling a product or service? What are you doing here?
Gaining.
You're gaining.
It would be a revenue.
It would be a revenue because in this case, right, you're generating income for the business by selling a product or service, right? So in this case, it would be a revenue. Okay, I'm going to put revenue. Okay, INC. Okay, revenue or income, whichever one you want to associate it with. Okay, what else? Now, if this is a revenue, right? Now, understand this, right? If we got cash for it, then yes, it would be an asset. But in perspective of this, the idea here is what was the action that was involved in order for you to earn that money, right? And that's what sales is. It's the action. Now, of course, if you actually got the money, right? If you had cash, then yes, that would be considered an asset. Okay. But in this case, we're just generating income and revenue. So in this case, what is the category for this one?
Would it be operating?
Correct,
That-
right? It'd be operating because in this case, it is the main core of operation. Or in this case, if you take a look, I think I have sales up there, but it is the main core of your business, right? Is that you're generating revenue for your main core of operations, okay? And then what would the normal balance be for revenues? Credit, right? You would increase your sales with a credit. Okay. What about capital contributions where you're investing money into the business?
It would be a credit.
Equity.
It would be a credit, equity, and no category, right?
No credit.
And then you said credit. Good. That's correct because we're looking at equity, right? How would you increase an equity? You would normally increase it with a credit. So that's good. No worries. Okay. All right. Next one we have is equipment. Okay. Any machinery or object to run the operations.
Assets.
It is an asset. Good. What kind of asset?
Fixed.
Fixed.
Good. Debit or credit?
Debit.
Good. Okay. All right. Okay, what about a notes payable? IOUs to other people. Now, here's a trick about notes payable, right? Notes payable in other ways that you can understand it, right? It is an IOU. But what can you do with an IOU? You can always renegotiate, right? In terms of what your agreement is with the IOU, right? You can finance what you owe. You can pay now or pay later, right? So that's a trick about notes payable. So what would this be if it's an IOU to other people?
A liability.
It will be a liability. Now, here's the question. Is it current or is it long term?
I would say long term.
Okay, so in this case, it can be long term. What else can it be?
Current.
It can be both, okay? Depending on what the situation and what the agreement terms are. So in this case, right, this kind of liability, right, because you can refinance or finance it again, right? You can have up to either a year or you can extend it, right? You could defer payments until you're ready to pay it off. Okay, so that's the trick about notes payables because the idea of it's an IOU, but you can renegotiate deadlines or renegotiate payment periods, then yes, it could be either current or long term depending on what the agreement is. Okay, now typically, what kind of normal balance would a liability have?
Credit.
It would have a credit. Good. Okay. All right, last three here. We have rent expense. Rent expense, paying for rent.
Asset. Expense.
100% it's an expense. Okay, now what kind of expense?
Operating.
Mm-hmm.
And debit.
Debit, good. Okay. Okay, so here's a tricky one. Delivery income. Okay, charges to customers to cover for delivery.
Income.
It is 100% income. Yes, it is. But now, what kind of income would it be?
Non-operating profit.
Not good. Non-operating or other income. Because in this case, right, well, we're talking about our company, right? We're talking about merchandising inventory, or sorry, merchandising operating activity, right? In this case, right, our main goal is to sell a product. We are not in the business of delivering stuff, right? We're in the business for selling a product or providing other services that sells a product, okay? So delivery income is going to be something that you are doing outside in the realms of your main core of operations, which is going to be considered other income, okay? And how would you increase income? With a credit. Good. Okay. Last but not least, okay, purchase expense, making purchases of for the business, okay, to for operations or for inventory items. So, what would this kind of be?
Expense.
Say that again.
Expense.
It would be an expense. Good. Now, what kind of expense would this be?
Operating.
It'd be 100% an operating expense, right? Good, because you're buying inventory to operate the business, or you buying items for you to be able to operate the business as well. So in this case, what is the normal balance? Good. Okay. All right. Good job. Okay. So with this being said, okay, I'm gonna give you a few what do you call it? Mnemonic devices. Okay, it's not really mnemonic devices, but in this case, I'm gonna have you kind of make it a little easier to recognize accounts. Now, most likely, okay, anything that is an expense account will typically have the word expense attached behind it, okay? So that will be a kind of a dead giveaway when you recognize an account that usually it will have expense at the end of it. You'll automatically recognize is an expense account, okay? Liabilities will typically have the word payable behind it, okay? So accounts payable, notes payable, sales tax payable, everything except for loans, obviously, because you can have a loans payable, but it's just much easier to just understand it as just loans, because yes, in other businesses, they do typically use loans payable. So it does exist out there. But yes, that's one way that you can recognize liabilities, is that it will typically have payable at the end of it. Now again, for assets, that's a little more difficult because pretty much all of the accounts that you see here were mostly assets. And so for you to determine it, it's just basically can you own this, right? Can you own inventory? Yes, you can. Can you own furniture? Yes, you can. Can you own land? Yes, you can. Can you own a copyright? Yes, you can. All right. But as far as that, in regards to revenues, the only revenues that you would typically see would just be sales. Okay. All right. Good job. So I will post the answers to this on the Google Classroom so you guys can have this as study materials. Okay. So it is exactly 10 o'clock. So go ahead and take your 20-minute break now and be back no later than 10:20, and we will finish up the day with chapter 3.